Most people talk about becoming a millionaire as if it were some kind of magic trick. They make it sound glamorous, mysterious, almost theatrical. One person says you need a side hustle that scales overnight. Another says you need to buy whatever is hot this month. A third says ordinary people have no chance unless they inherit money, join the right circle, or take the kind of risk that would keep a sensible man awake at night. I have never found much wisdom in that sort of talk. When I want to understand how wealth is actually built, I prefer to start with something less entertaining and more useful. I prefer evidence. I prefer broad patterns. I prefer reality over mythology. And reality is usually quieter than the stories people tell. If you strip away the noise, the path to $1 million is not usually dramatic. It is not built on brilliance. It is not built on a perfect market call. It is not built on catching one spectacular break and spending the next 20 years telling people you meant to do it all along. It is built much more often on a set of durable behaviors that do not look exciting in the moment but become astonishing over time. That matters, because the word millionaire has become almost useless in ordinary conversation. People throw it around so loosely that it stops meaning anything. Some people use it to describe a lifestyle. Some use it to describe visible spending. Some use it to describe a house, a car, a zip code, a wardrobe, or a social media persona. I do not think that way. I think in terms of net worth. I think in terms of assets minus liabilities. I think in terms of what a household truly owns, what it truly owes, and what portion of that wealth is actually productive. And I also think it is important to make one distinction immediately. A household can have $1 million of net worth, including its primary home. And that certainly counts in one sense. A paid-off house brings security. It lowers stress. It changes your financial life for the better. But there is another category that matters deeply, and that is investable wealth. A house you live in may protect you. It does not automatically produce spendable income. It is not the same thing as a collection of productive assets compounding on your behalf. That difference is not academic. It is practical. A man who confuses the value of his house with the value of his investment engine can draw the wrong conclusions about what sort of freedom he really has. There is another point people miss. When you look at wealth, you should be very careful with averages. Averages are often distorted by the truly enormous fortunes at the top. They create an illusion. They make ordinary outcomes look more dramatic, and dramatic outcomes look more normal than they really are. I have spent enough time around money to know that the average can flatter the imagination while misleading the mind. The median is often more useful. The median tells you what sits in the middle. It gives you something closer to the ordinary case. And if you want to learn how wealth is actually built by real households, ordinary cases are exactly what you should study. Once you do that, a handful of patterns appear again and again. Not 10,000 patterns, not a secret checklist known only to insiders. Just a few highly repeatable habits that separate the people who gradually accumulate wealth from the people who only talk about it. The first habit is simple, but because it is simple, people underestimate it. Millionaires save a lot, and they do it consistently, not perfectly consistently. There is a difference between those two things, and it is a very important one. When most people imagine a wealthy household, they picture one of two caricatures. Either they imagine somebody spending like a cartoon king surrounded by excess, or they imagine a miserable penny pincher who derives joy from turning off every light bulb in the house and watering down the soup. Both pictures are silly. Most real wealth is built in a much less theatrical way. The common pattern is not obsession. It is structure. Wealthy households tend to save a meaningful portion of income year after year. They do not save only when conditions are pleasant. They do not save only when work is smooth. The market is rising, the children are inexpensive, the roof is not leaking, and nobody needs braces. They save through interruptions. They save through uneven years. They save through the kind of ordinary life turbulence that ruins the plans of people whose system depends on convenience. That is why I say the important thing is not perfection. It is persistence. A family that saves only when nothing goes wrong is not operating a savings plan. It is operating a savings fantasy. The more revealing question is this: what happens when life gets messy? Do you still save something? Do you slow your lifestyle growth before you sacrifice your investing habit? Do you keep enough room in your budget to absorb pressure without destroying the machinery of compounding? That is where the difference begins to show. Many people tell themselves they will save whatever is left over. That sounds harmless. In practice, it is often fatal to long-term wealth building. If savings is whatever survives after housing, cars, subscriptions, upgrades, vacations, convenience, and impulse spending have all taken their turn, then savings is not a priority. It is a leftover category. Leftover categories do not usually become fortunes. Wealthier households often do the opposite. Saving comes off the top. Investing comes off the top. Lifestyle expands more slowly than income. And when income rises, part of that rise is captured instead of being immediately handed over to a more expensive standard of living. That one behavior, repeated over decades, can change a life. People imagine that wealth requires some giant leap. Usually it is a long sequence of smaller captures. A raise comes in, and rather than allowing every new dollar to become a permanent obligation, the household takes some portion and routes it into ownership. A bonus arrives, and rather than turning it entirely into consumption, they convert some of it into productive capital. Expenses rise more slowly than earning power. The gap between what comes in and what goes out is protected. Over time, that protected gap becomes a force. It is not flashy, but it works. And when pressure arrives, the disciplined household does something else that matters. It adjusts without abandoning the game. There may be years when the savings rate falls. Childcare can do that. Health events can do that. Business launches can do that. Career disruptions can do that. Life is not a straight line, and I do not trust any financial philosophy that pretends it is. But the better pattern is temporary adjustment, not permanent surrender. The habit bends. It does not disappear. That is the first habit. The second habit is the one that many people resist because it feels less emotionally comfortable. Millionaires invest. They do not merely save. They invest. This is where a great many households go wrong. They think the noble act is setting money aside, and once it has been set aside, they want to keep it where it feels safe. Safety has emotional appeal. Cash is quiet. Cash does not swing around. Cash does not tell you bad news at the end of a violent market week. But cash has its own violence. It just happens more slowly. Over long stretches of time, money that is not productively invested gets eaten by inflation, by stagnation, by the silent erosion of purchasing power. People fear volatility because they can see it. They fail to fear non-participation because it looks calm. I have often found that what feels safe in the short run can be dangerous in the long run. That is why the line between ordinary savers and actual wealth builders often appears at the point where dollars stop sitting still and start owning productive assets. Stocks, mutual funds, broad index funds, retirement accounts, invested in businesses, those are not merely containers. They are claims on productive enterprise. They give your money a job, and if you hold them long enough, they allow time to become your partner rather than your opponent. A household that saves diligently but never truly invests is trying to row a heavy boat with one oar. It can make progress, but not enough progress for the destination. Most people say they want. One of the most useful truths in finance is that saving determines what you keep, but investing determines what your money can become. Without the first, you have no fuel. Without the second, you have no engine. Now people often hear that and assume I am about to recommend some exotic scheme or some clever method of outsmarting everyone else. I am not. In fact, one of the striking things about how many millionaires build wealth is how ordinary their investments are. They are not all brilliant stock pickers. They are not all venture capitalists. They are not all discovering secret asset classes at private dinners. Many simply participate in the productive power of business over long periods of time. That is much less glamorous than the mythology, but much more profitable than the mythology. They stay invested through recessions, through ugly headlines, through bear markets, through years where it feels as if nothing is happening, through years where it seems as if the patient person is being punished and the reckless one is being rewarded. They continue because they understand a basic truth that never stops being true. Time in productive assets matters more than emotional comfort in any given month. There are many things in life where late certainty is better than early action. Investing is often not one of them. In many cases, confidence follows participation, not the other way around. The beginner waits to feel ready. The wealth builder understands that readiness is often produced by beginning. The third habit follows naturally from the second, and it is one of the least appreciated advantages available to ordinary people. Millionaires use tax-advantaged accounts aggressively, not necessarily cleverly, aggressively. That is another distinction worth understanding. People love to argue about technical optimization before they have built the base. They want to debate this account versus that account, this tax bracket versus that tax bracket, this conversion versus that sequencing strategy, as if the major risk in their financial life were choosing the wrong shade of efficiency before they have accumulated much at all. That is backwards. The first-order question is not whether every detail has been optimized. The first-order question is whether you are regularly using the tax-advantaged space available to you at all. A retirement account funded year after year does something very powerful. It automates good behavior, it reduces friction, it creates discipline, it lowers the annual drag that taxes can impose on compounding. And over an entire working lifetime, reducing that drag is not a trivial improvement. It can be the difference between mediocrity and real scale. A great many households would do better if they stopped trying to look sophisticated and simply became consistent. Put the money in, do it again, keep doing it. Let the years do what the years are capable of doing. You do not build a large retirement balance with occasional enthusiasm. You build it with repetition. That is true in business, in investing, in skill development, and in character. Repetition is underrated because it is boring to describe. It is also where a great deal of success comes from. So many people want to optimize before they participate. I think that is a mistake. Use the space first. Build the habit first. Accumulate the base first. Later, when the balances are meaningful and the tax questions become larger, then the finer points deserve more attention. But people who spend all their time polishing theory before they build assets are doing something like arguing about the best storage system for grain before they have planted a field. The fourth habit is one that people resist because it touches the part of life that is easiest to justify emotionally. Millionaires control the big expenses, especially housing. This does not mean they never buy comfortable homes. It means they understand what a house can become if handled poorly. A house is not just shelter. It is also a budget decision with very long If the monthly obligation tied to housing becomes too large, it constrains everything else. It constrains savings, it constrains investing, it constrains resilience, it constrains mobility. It constrains the ability to absorb an economic surprise without financial panic. That is why I think of housing not merely as an expense, but as a structural choice. Many households do not become strained because they are irresponsible in 1,000 small ways. They become strained because they are overcommitted in one or two large ways. Housing is often one of those. People frequently upgrade housing the way they upgrade ego. Income rises, and immediately the house must rise with it. A promotion arrives, and the family starts shopping for proof of success. The trouble with that is not only the cost itself. The trouble is the permanence of the cost. Big fixed expenses do not politely disappear when the economy turns, when a child needs help, when health changes, or when a job becomes unstable. That is why optionality matters. Wealthy households often preserve optionality by refusing to let housing dominate their financial life. They buy with margin, they stay put longer, they avoid the habit of serial upgrading, they understand that a larger house can consume cash flow that would otherwise have been converted into productive assets. This is one of the least glamorous truths in wealth building. You often become wealthy before you look wealthy. In fact, one of the most common mistakes people make is using visible lifestyle as a proxy for invisible financial strength. A big house may signal income. It does not automatically signal freedom. A household with a moderate house, strong savings, manageable obligations, and a substantial investment base may be far wealthier in the practical sense than a household living in a showcase they must continuously feed. That is why I prefer margin over appearance. Margin lets you keep investing when life becomes expensive. Margin lets you survive shocks. Margin lets you say no to bad opportunities. Margin lets you think clearly, because every decision is not made with your back against the wall, and that is what housing should protect, not destroy. The fifth habit is the one that supports all the others. Millionaires stay invested for a long time. That sounds unimpressive until you notice how few people truly do it. Everyone says they understand compounding. Much fewer people behave as if they understand compounding. Real compounding is boring at first. It demands effort before it provides visible reward. It asks for discipline long before it offers applause. In the early years, progress can look almost insulting. You save, you invest, you wait, and the results seem small compared with the effort. That is exactly why so many people fail to stay with it. They assume they are behind because they do not yet see a dramatic number. They assume the process is not working because the graph has not become steep enough to flatter the ego. But wealth is rarely built in a straight line, and it is almost never built instantly. The early years are foundations. You are not supposed to look finished in the foundation years. You are supposed to be laying the base that later years will magnify. I have always liked businesses that earn trust gradually and compound reputation over time. Personal wealth works much the same way. The beginning is not impressive. The middle becomes interesting. The later years can look almost magical to people who did not witness the decades that came before. That is why patience matters more than excitement. People are often shocked to learn that many millionaire households do not arrive there early in life. They arrive there eventually, and that word eventually contains most of the lesson. The ordinary path is decades long. It is not a sprint. It is not even really a race. It is a long glide path in which small disciplines are allowed to compound without interruption. And that is where another myth falls apart. People love to think millionaires are special because it flatters the person making excuses. If wealth belongs only to geniuses, insiders, inheritance recipients, and market magicians, then the ordinary person has been absolved. He can say the game was never available to him. Reality is less convenient than that story. Many wealthy households did not earn extraordinary incomes. Many never had perfect timing. Many never used complicated strategies. Many were do-it-yourself investors for years. Many built seven-figure net worths through ordinary instruments, ordinary consistency, and extraordinary patience. That is not only true, it is encouraging. It means the game is not reserved for a tiny class of extraordinary people. It means behavior matters more than image. It means structure matters more than slogans. It means the wealth gap between two households with similar incomes can often be explained less by brilliance than by repeated choices made quietly for 20 or 30 years. There is one more thing I want you to notice. These habits reinforce one another. The household that controls housing usually has more room to save. The household that saves consistently has more capital to invest. The household that invests through tax-advantaged accounts improves the efficiency of compounding. The household that stays invested for decades gives all prior decisions time to matter. This is why wealth building often looks nonlinear. At first, each habit seems modest. Later, they begin interacting. The machine starts helping itself. Cash flow produces capital. Capital produces growth. Growth increases flexibility. Flexibility makes consistency easier. Consistency strengthens the next round of growth. People who stand outside that process think a miracle occurred. Usually no miracle occurred. The habit simply had enough time to become visible. I have spent enough of my life in capital allocation to know that most great outcomes are not the result of constant brilliance. They are often the result of avoiding destructive behavior long enough for sound behavior to accumulate. In that sense, millionaire building is less about heroic action than durable avoidance. Avoid the house that owns you. Avoid the lifestyle that expands faster than income. Avoid the cash pile that never learns to work. Avoid the endless search for certainty before beginning. Avoid the impatience that quits before the arithmetic has had time to become obvious. If you do those things, and if you persist, the odds change. Not immediately, but meaningfully. That is why I do not like talking about wealth, as though it were a personality trait. It is not charisma. It is not an aesthetic. It is not even mainly a matter of intelligence. It is much more often the product of repeated decisions made under ordinary circumstances. A household decides to save first rather than last. A household decides to invest rather than merely store. A household decides to use the structures that reduce friction and tax drag. A household decides not to let housing consume its future. A household decides to stay in the game long enough for compounding to stop being theoretical. That may sound too plain for people who want a secret, but I have found that the plain truths are usually the ones worth keeping. The loud advice tends to promise transformation without discipline. The useful advice tends to sound almost dull because it asks you to accept reality as it is. Money grows slowly before it grows quickly. Wealth usually belongs to the persistent before it belongs to the brilliant. Big outcomes are often the visible result of invisible regularity. So if you want to know what everyday millionaires really look like, stop looking for a dramatic story. Look for the household that captured part of every raise. Look for the family that invested through ugly markets instead of waiting for comfort. Look for the couple that filled retirement accounts year after year without making a religion out of optimization. Look for the person who bought a house that left room instead of buying a status symbol that demanded sacrifice. Look for the investor who kept going through the unremarkable years when almost nobody was impressed. That is usually what wealth looks like before other people notice it. And that, in my experience, is also what wisdom looks like when it is applied to money. Not noise, not performance, not speed, just a handful of sound behaviors repeated long enough. By then, the person living it usually knows it was anything but exceptional. It was disciplined, it was structured, it was patient, and above all, it was persistent.